Hi, my name is Chris Bird, and I am a speaker on taxes and financial planning around the country for real estate groups, accounting groups, CPA groups, things like that. My background, I'm a certified financial planner. I'm enrolled to practice before the IRS. New tax law and tax strategies are what I do. Let me just kind of give you some basics about the theory of taxation. So everything I teach, it's based on the fact that you got to have a competent tax professional. If you don't have a CPA or an enrolled agent, an EA, in your corner planning your taxes, then you're making a mistake. And that's not to say that people without credentials are not good, everyone, but if you're going to take a chance on somebody being professional, then at least go to somebody that's got credentials to back it up. So everything I'm talking about in this webinar series is focused on you talking to your accountant about what I'm talking about. Don't do anything on your own. All right, so feel free to show this presentation, this live video, the slides that I'm giving you as part of this. I have no trouble whatsoever, and that's all there is to it. Now, what I want to do is I want to introduce a concept that's going to bother some of you, and that's okay. I've gotten in trouble for this before. But most people don't want to pay a lot of income taxes. And I get that, all right? But I'm just the opposite. I pride myself every year on how much taxes I pay. And here's my point. The more you pay, the more you make. And you can argue with me all you want, but that's the case. People have come to me over the years and say, well, I owe no income tax. And my point to them is, well, you made no money then. And that's a hard concept to get, everyone, but I'm one to tell you, and again, I've gotten in trouble over this with some people, I want you to pay 100 grand, 200 grand in taxes to the federal government every year, because to do that, you probably made $500,000 to $700,000 to $800,000 in the process. So my point is, too many taxpayers want to pay the lowest, if any, amount of taxes each year. Secondly, I'm one to say, and believe me, it's good to pay taxes. So now what I want to do in the third bullet is I want you to get used to the fact that you don't want to lower your tax bill to the lowest number every year because you're wasting your tax deductions. And let me just show you a chart. This chart is the tax rates for 2023. Now, they differ a little bit in 2024, but 2023 is good enough. Notice my three filing statuses. For those of you that are single, for those of you married, filing joint returns, and then for head of household, which is a special status right in the middle of these two for single parents with children. That's the head of household. Now, here's the deal. Look at the rates. We go from a low of 10 to 37%. Now, if you were in the first series of the webinar, the one that I did before this, I told you that in 2026, these rates may very well go up. In fact, one administration is already talking about raising to 37 to 39 to 40%. And that's just food for thought starting in 2026. But what I want you to do is focus on the various rates. So 10 through 37. And notice the income levels. So as you go and progress through the rates, 10, 12, 22, 24, as you climb the rates, it is on higher levels of income. So it's called a progressive tax rate. You've all heard the saying, the more you make, the more they take, and that is absolutely true. But focus on the three lowest rates, 10, 12, and 22, and look at the income that this applies to going from left to right. So my point is, if you're at those three lower marginal tax rates and your accountant can tell you whether you are or not, those are the years you don't want to be aggressive with your tax write-offs. You don't want to accelerate depreciation. You don't want to buy the heavy SUV to get the big write-off, things like that. Because the tax savings when you're at a lower bracket are much less than the tax savings when you're at a higher bracket. And let me illustrate. Let's just say we're talking about a $10,000 deduction, whatever it is. Maybe you bought a series of drones, who knows, all right? Or a new computer system. Now, the issue is you get to write off that 10 grand, all right? Now, if you're at the 12% tax bracket, 12% of 10 grand is $1,200. If you're at the 35% and you've got a $10,000 deduction, you just save $3,500 in tax. People don't think about this, but accountants do. So when you tell your accountant about what I just said, they will absolutely love you for it. They'll love me for it, because this is accountant speak. This is not taxpayer speak. So don't crave your deductions. In lower income years, and I know for a fact, because I've got a lot of real estate clients, that 2023, and 2024 can be an off year for a lot of real estate agents because of high dollar cost, high mortgage rates, low inventory. I see this with a lot of my real estate clients. So maybe 23 and 24 is not the year to be aggressive with your deductions. Wait until your income is at higher levels. Thanks, and I'll see you again.